Great, thank you. Hello everyone, my name is Poorya, and today I will be presenting Reducing Racial Disparities in Consumer Credit, Evidence from Anonymous Loan Applications. And I want to thank the organizers for organizing this wonderful conference and asking us to present our paper. This is a joint work with my colleague, Poorya, who is also attending this. Okay. So we know that racial disparities in access to credit exist. And we know that access to credit is very important. There has been various policies to reduce racial disparities. I'm going to give you a few examples of these various policies, and some of them take a particular form. They restrict the use of information that is correlated or predictive of race. Okay? So for instance, in the US context, if you think about it, there are regulations that prevents lenders from using racial composition of a neighborhood in which an applicant lives in lending decisions. This is true also in the insurance market. Okay, so insurance pricing cannot depend on the racial composition of the neighborhood. Okay, so what is the goal of these policies? The goal of these policies are to reduce racial disparities. Okay. Now, we are in today's talk. I'm going to talk about a particular policy that has been proposed in the European context. It has been proposed, and some European countries even experimented with this in the context of the labor market. What is that policy? The policy is the removal of a racially identifying variable that is applicant names. Okay. So. In today's talk, I'm going to basically be talking about whether anonymizing loan applications is an effective way to reduce racial disparities, okay? Now, anonymizing applications by humans can be time-consuming and error-prone. However, if you think about it, fintech enables cost-effective implementation of anonymous applications. So what a fintech company can do, and this is going to be our setting, is basically the fintech company is going to serve as an intermediary between applicants and lenders. Applicants are going to submit their applications to the fintech company, which is basically going to be an online loan comparison platform. The platform receives the application and sends it to lenders. Lenders make an accept or reject decision, and then applicants choose and go to the lender branch in person for this loan application. Okay? But essentially, these fintech companies can verify that these applicants are real. They can basically remove applicant name, and then they can pass this information to lenders. Okay? So this is going to be the intervention that I'm going to be talking about. Now, whether anonymous loan applications can successfully reduce racial gaps in access to credit is ambiguous, okay? So, first of all, for this particular setting, for us to have a say about racial disparities, it should be that lenders use race beyond objective risk measures, and they use race to make lending decisions. Okay, so we are going to establish that lenders in our setting are indeed using race to make lending decisions, okay? But racial disparities is going to disappear if you remove names, if lenders only rely on name as a proxy for race, okay? Racial disparities will decrease if other application characteristics are correlated with race, and lenders can somehow infer, at least partially, race by looking at other application characteristics. And it could also be that racial disparities increases, and this has been documented by these two papers. Essentially, if beliefs are biased or signal precision differs by race, racial disparities could increase if you anonymize loan applications. Okay? All right. Okay, so this is what we are going to do in this paper, and I highlighted basically the key takeaways of this paper in yellow. Okay, so if you want to remember anything from this paper, it's the ones that I highlighted in yellow. Okay, let me tell you a little bit about what we do. Okay, so we studied the effect of anonymizing loan applications on racial disparities in personal lending in Singapore. Okay, Now, what data do we have? We have data on loan applications, we have data on approvals, and we have data on loan originations, and we are going to have data on loan performance from one lender, and I'm going to describe why we have data for loan performance from one lender, okay? What is the setting? The setting is Singapore, and the platform that we have the data from, at some point they decided to remove applicant name. Why? Because they had concerns for applicant privacy. So they were sending applications that they received from applicants to lenders, including applicant name. But on September 28, 2021, they basically removed applicant names. And this is going to be basically our natural experiment. So this is going to be the setting, okay? So what do we find? We find that with names on applications, okay, so when lenders can see names, there is racial disparities, okay? So ethnic minority applicants are 10% less likely to receive loan offers than otherwise observably identical Chinese applicants. Now, why Chinese? Because in our context, Chinese are going to be the ethnic majority, okay? But I want you to pay attention to observably identical. The reason that we put observably identical is that the application is online. So we can observe whatever lenders observe at the time of decision making. This is important because in this particular literature, the big criticism, or one of the big criticisms, is that you don't observe everything that the lender observes. Maybe lenders and borrowers interact with each other in one way or another, and these interactions are differentially informative by race. If these interactions are differentially informative by race, you cannot just use application characteristics, because there is interaction that you don't observe. For us, this is not going to be the case, simply because we observe everything that the lender observes. Okay, so this is going to be important. Okay, the first finding of the paper is that racial disparities exist. The second one is anonymizing applications substantially reduces such disparities. Okay, so the first finding is that actually anonymization works. Okay, so this has been proposed in several, that's been proposed and experimented with in the labor market. In the lending market, it actually works. Okay, and the second one, yes.
I'm sorry, Poorya, I had to ask this question. So what about lenders' experience? Do you observe that, for example?
Yeah, let me get back to that. Yes. Okay. Okay. So high income. Okay. So the second point of the paper is going to be high income minorities benefit more, and we are going to take this as evidence that lenders, after this intervention, increase their reliance in objective credit risk measures such as income. Okay. So basically, the first point is that anonymization works, and part of the reason that it works is that once you remove a subjective criteria such as race, lenders seem to be using objective credit risk measures such as income more so, okay? And then we don't observe racial gaps in loan performance either before or after the change, okay? All right. Let me tell you a little bit about the details of how this platform works. So basically, you can think of it as 4 different steps. The first one is you go online, you spend a couple of minutes, and then you apply for a loan in a few minutes. Okay. The second one is you receive offers from multiple lenders online. Okay. The third one is you, as an applicant, if you receive offers, you're going to choose one of them. Once you choose one of them, you have to show up in branch, in person. This has to do with a regulation in Singapore. So the money lender or the lender cannot be basically giving you a loan without you actually physically going to the lender branch. Okay. Okay. So what does an offer look like, or what does the lender do? The lender can reject or give you an offer. Okay. So when the lender gives you an offer, the offer is going to have 4 different characteristics. And these are stuff that is typical, right? So we will observe loan amount. we're going to observe loan maturity, we're going to observe interest rate, and we're going to observe the processing fee. Okay, so these are going to be the 4 observables of each contract. So if a lender approves the lending decision, they basically give you these 4 characteristics as the offer. Okay, all right. So what is the data? Again, so the data is basically coming from loan applications, approvals, and originations. The sample is 16 months. It's from October 2020 to January 2022. So we observe all the application characteristics, but most importantly, we observe applicant name, both before anonymization and after anonymization. So this is important because it is true that lenders do not observe applicant name, but we observe applicant name both before and after. Okay? We basically observe a bunch of basically low characteristics, and then as I told you earlier, the applicant needs to show up in branch in person, and we basically observe whether there was a loan disbursement, and if there was a loan disbursement, what are the terms of the loan disbursement. Okay? All right. So let me tell you a little bit more about the context that is Singapore. And then, okay, before doing that, I think the kind of market that you're considering is basically unsecured lending. You can think of this as high-cost borrowing, okay? So the interest rate on these loans are going to be 100%, okay? So these are going to be, relatively speaking, a small loan. I think the average loan in our sample is going to be 4,000 Sing dollar, which is about 3,000 US dollar. So these are small loans, these are unsecured loans, and these are high interest loans, okay? So this is not exactly payday lending, because for payday lending you need to basically show that you have a job and the money is going to be taken out of your bank account. But this is uncollateralized, and it is similar in that it's high interest rate loan. Okay? All right. So let me talk about the context. The context of this experiment is basically Singapore, and Singapore is basically, it's a city-state, okay? 74% of the population is Chinese, and 13.5% are Malays, and 9% are Indians, and then the rest are other races, okay? So we are going to use the term minority to refer to non-Chinese, okay? All right. So now you might be asking, okay, how do you figure out the race of these people? Now, we made a choice to use the race that is identified by RAs. So we are going to give the names to RAs, and then they will decide. So these are the Singaporean undergraduates who will decide the race of these people, and then if they agree, we are going to use that number. Now, we have actual data from government records, so we cross-check, and then it's highly accurate. So the accuracy of this mechanism is basically more than 98% of the times, the Singapore government and RA predictions align with each other, okay? And it has a specific reason that I'm going to talk about in the next slide. Basically, names in Singapore tend to be racially identified, okay? So if you think about John, John could be a white applicant in the US, or it could be an African American. So, but we don't know really what is the fraction of each. In Singapore, this is not going to be the case. Names are going to be racially identified. And this is going to help us in the following sense. If you follow this literature that has tried to establish discrimination and send CVs, they use black-sounding name versus white-sounding name. In our setting, we can sort of think of most of the names as either minority-sounding name or Chinese-sounding name. Okay? So these are going to be different. Okay? We are going to put one sample restriction. So the sample restriction that we are going to put is basically we are going to look at the set of applicants whose applications, part of their application characteristics is going to come from Singapore government official records. Okay? And basically, the reason that we do this is we just want to make sure that these are real applicants, okay? But I will have a test in the appendix showing that this doesn't matter, okay? All right. So this is the graph that I was talking about, okay? So on the left, I'm basically, so for each name, okay, I basically take the fraction of the name that belongs to minority, okay? So let's say John, we have 5 John in the data. One of these Johns is a minority, for the rest of them are Chinese, okay? Then we will assign a value of 20% to John, and we will basically plot the histogram. What you can see here is that there is a large mass on 0%, and there is a large mass on 100%, okay? So 0% are names that are only used by Chinese, 100% are names that are only used by minorities, and as you can see, names in Singapore tend to be racially identified, okay? All right. So this is the first result of the paper. This is we are not doing any controls here, but you can observe basically in the pre-sample, the average offer probability. I want you to focus on the basically first line. The average offer probability for minorities is lower than average offer probability for Chinese. And as you can see, the average offer probability is still lower for minorities relative to Chinese, but it's marginally statistically significant in the post-sample, okay? We have other application characteristics, and I'm going to show you these ones in actual tables where we control for stuff. Now you might say, look, this is unconditional. Once you do the conditioning, this is going to disappear, okay? So the next graph, the next thing that I'm going to do is I'm just going to do conditioning, okay? So what do I mean by that? Remember that this important feature of this setting is that we observe all the application characteristics that lenders observe. So we are basically going to control for that. Okay, so that's going to be our regression specification, and we are going to put in a bunch of fixed effects and control variables as well. But the key feature here is that we observe application characteristics, and we basically control for it. Okay, so this is one of the main results of the paper. Basically, if you look at offer indicator, what you see is so the ones in orange, okay, are pre, the ones in blue are post, okay? So you can observe that minorities before anonymization had lower offer rates. It doesn't matter how you control or how you collapse the sample, all the columns are basically saying the same thing, okay? So before anonymization, you observe racial disparities. Now, the average offer probability is about 40%, so you divide 3.8 by 40%, you will get to the 10%, which is basically the racial disparities, that the headline number that we report, okay? And what you can observe here in the post, racial disparities disappear, okay? All right. So this is basically this is the pre-trained graph. So we're basically plotting what we did. The only thing that we do here is we basically plot the coefficients for on a monthly basis for before anonymization and after anonymization. Okay, all right. Okay, so now this is, I think, an important graph. Okay, so what do we do here? On the x-axis, what we do is for each lender, we estimate lender bias. Think of it as, for that particular lender, what is the fraction of minorities that this lender lends to relative to Chinese, okay? So the ones on the left, minus 10, minus 5, these are going to be the lenders that are biased against minorities. And then the ones on the right are the lenders that are biased in favor of minorities, okay? So that's the x-axis. What do we do on the y-axis? On the y-axis, we are plotting beta post minus beta pre. What is beta post? If you think about, if you assume that, let's for 1 second assume that anonymization reduced racial disparities for every single lender to 0. Then beta post is going to be 0, and this is going to be minus beta 3. So you would expect to observe a minus 45-degree line, okay? And this is what we observe. Now the reason that this is important is, first of all, it provides evidence that this is the reason that racial disparities disappeared is not because There's one lender that has started lending more suddenly to minorities, one lender started lending less. This seems to be more or less effective, irrespective of how much bias you had against minorities. The second one could be policy relevant, okay? In the following sense. So there is an experiment in French context. What they do is basically they let institutions choose whether they want to receive anonymous applications or applications with name. Now this is important because if the two guys on the right were the only ones that participated in such an experiment, you would observe that racial disparities actually increases after anonymization. Why? It could be that the two guys on the right are going to participate, because these are probably people who have preferences for minorities, and if they are more likely to participate in such an experiment, this is going to affect racial disparities in the opposite way. So racial disparities could increase, okay? Now, and I think this is part of why in this setting we find that this works, because this treated every single lender at the same time. So lenders could not select into or out of observing anonymous loan applications, okay? All right. Okay, so disparities in the intensive margin, okay? So here we are basically looking at loan offer a month, logarithm of loan offer a month, and they're looking at offer maturity in months, and they're also going to look at effective interest rate. Now you might be thinking, what is effective interest rate? Because the loans that we observe in our data have interest rate and processing fees, and they have different maturities. We basically use very simple discounting to basically come up with something called effective interest rate, okay? But basically, the idea is that this is interest rate, and we are on top of that taking into account the fact that these loans have different maturities. Not only that, these loans have different processing fees, okay? So we're basically including all of this to come up with this measure effective interest rate. So what you can observe here is that actually anonymization not only was effective in the extensive margin, it is also effective in the intensive margin, okay? So the outcomes for minorities improve on the intensive margin. So they get lower loan amount, they get higher loan amounts, they get longer maturity loans, and they get less interest. Now, I want to make this one comment about longer maturity loans. Now, longer maturity loans in our setting, it ends up being better, and I'm going to show you one direct evidence for that. But for now, you can think of longer maturity loan as being better because you have lower monthly payments, okay? So if you have a longer maturity loan, you will have lower monthly payment. But I'm going to show you that actually, if you look at the choices made by applicants, they are actually more likely to choose longer maturity loans as well. So this is consistent with the demand function of the applicants as well. Okay? All right. This is basically the second main message of the paper. Okay? So this is a bit of a crowded paper, a crowded table. What I want you to focus on is only the first column. Okay? Column 2, 3, and 4 is basically looking at different outcome variables, but the intuition and the message is basically the same. Okay? I want you to only focus on column 1. Okay. So for column 1, what do we do? The previous coefficient that I was showing you was for pre. Now we are splitting this coefficient to high income and low income minorities. We are doing the same for high income and low income minorities for post. Okay? What do we see? The first one is we observe that high income minorities pre had were receiving lower offer rates relative to Chinese, which is the omitted group here, but and this is more or less similar for high and low income minorities. So both high income and low income minorities were receiving lower offers, and the magnitudes are very similar. So in some sense, in the pre-period, it wasn't that high income minorities were getting much better treatment. High income minorities were not getting, were getting a slightly better treatment, but not too much. However, in post, you would observe that high-income minorities actually, the offer probability for them increases, and you would observe that the low-income minorities are better off as well, okay, but to a lesser extent. So this is the evidence that we are using. So this table, we are interpreting the findings of this table as it is as if lenders, after you remove race, lenders rely on income more to make these lending decisions, okay? There is one other thing that we did, I think we wrote it in the paper, but essentially if they increase lender reliance on income, you might expect to find that the R squared of a regression where the left-hand side variable is offer probability and the right-hand side is income, increases post, right? And this is exactly what you would observe in the data, okay? So post-anonymization, lenders started using income more for making lending decisions, okay? All right. Okay, so we do a bunch of robustness tests, okay? So the first robustness test that we do is, in the labor literature, it turns out that the main alternative to using, so the main alternative explanation for why racial disparities exist when you send these black sounding and white sounding resumes is names are a proxy for social status, okay? So now I don't think that we don't think that this particular critique is going to be applicable to our setting just because we observe income, which is a measure of social status, socioeconomic status, and we observe a bunch of other variables as well. Here, however, we have a test to do this more formally. So what we do is basically, we use a leave one out approach. So think of John Doe, okay? We basically look at, so we want to basically come up with a measure of what is the social status of John Doe, okay? So we basically split the name into two parts, John and Doe, and we use a leave one out approach to take the average of the income of all the Johns in the sample. We're going to do the same for all the Does, and then we are going to take the average. If one of them is missing, we are just going to put missing value there, okay? So we're going to take this average, and then it turns out that if you control for this measure of socioeconomic status, the regression coefficient barely changes. Okay, so we don't think that this is really about socioeconomic status story. We think it is really a race story. Okay? The second robustness test is, which I think this is also a nice test in the paper, is that we test for demand. Now, you could come and say, hey, you know what? Lenders were really helping minorities because they know the demand function of minorities is different from the demand function of Chinese. So what they're really doing is that they're catering to their demand. Now, for those of you who have been following the US literature on discrimination, there is this paper in RFS by Bhuta and Gizmo, and that is actually their explanation. They basically claim that the reason that you observe differences in interest rates by black versus white mortgage applicants is because they have differences in demand. This is actually something that we can test in the data, and I don't think that this test, you can test this in a lot of other data sets, okay? How can we test in the data? Remember that for one applicant, we observe all the offers and we know which offer they choose. So basically here what we do is basically, in the first column, we basically look at whether the probability of choosing an offer is different for minorities versus applicants, okay? So these are offer indicators times 100, okay? So this is not, so the first column is not 20%, is 0.25%, okay? So it's less than 1%, okay? That's the first. The second column, what we are doing is, you might say, you know what, the offer characteristics are different, why don't you control for them? This is exactly what we do. The third one, we look at the intensive margin. So what you do here is basically, within an applicant, we look at which offer they chose, and we compare the choices made by minorities and Chinese. Again, the key takeaway here is that the demand between Chinese and minorities are not that different. Okay? All right. okay, so this is an interesting feature of our setting. And initially, when we wrote this paper, we were more excited about this part of the setting, but we tried to push it back because of data limitations. Okay, so let me tell you about this part of the setting. Okay. So if you think about our setting, what happens? In our setting, basically, there is a loan applicant. So an applicant goes online, fills out a form, the lenders come back with offers, but the applicant needs to show up in person in the branch. What does that mean? That means that if race is going to be eventually observable by the lender. So if you think about it, this experiment of ours, what it did is basically it removed race from the first stage of lending, but the total information in the entire process has not changed. It's just that the information about race delayed until applicants show up in branch. Okay? Okay, so what happens here is that, so this is basically, the first column is what you have observed before, okay? So you have observed the first column before, it's just a copy of the first column that you have observed before. The second column is the new one, okay? So here we are looking at origination. Origination is the stage in which race is eventually observed by the lender. What you observe, and part of the reason that we don't have a lot of statistical significance there is that this is applicant-lender pair, so we have 300 observations at the applicant-lender pair level, but we have 3,000 final loan originations. Remember that an applicant can get 7 or 8 offers, but they can one of them only can lead to loan origination. Okay? Okay, but what do we observe here? What we observe here is that there exists racial disparities in loan origination pre, but these racial disparities in loan origination pre is decreased substantially post, okay? So we do some calculations to try to, we refer to this in the paper as partial adjustment, and we can sort of see that racial disparities still exist pre, even though it's not significant, and it is partially adjusted. It looks as if the lenders are including race once the applicant shows up in branch, because racial disparities are not completely removed. Okay, so this is our interpretation in the paper. Okay, so again in the previous version, we were basically the pitch of the paper was that delaying revealing information about race is an effective way of reducing disparities, okay? But this is a B2B, that's the reason that we decided to not go with this pitch now. Okay. Okay, so this is part of, unfortunately we have data from one of these lenders, okay? So the reason that we have data from one of these lenders is that, so there are 37 lenders in our data. We have data on loan performance from one of these lenders. Why? Because this lender has a profit sharing agreement with the platform. So they actually report whether this applicant paid, how often they paid, how much they paid, and so on and so forth. For the rest of the lenders, unfortunately, we don't observe loan performance, okay? But it is what it is. This is the result that I wanted to show you. Basically, we don't find racial disparities in lengths of coverage and delinquency indicators, both pre and post. Now, you could say that the reason that you don't find this is because the data is not large enough, and that is possible. Okay, so I don't want you to take this too strongly. Okay, but okay. Okay, so I have about 5 more minutes. Okay, so we do a bunch of robustness tests. Let me talk a little bit about this one that I think is important as well. Okay, so if you think about it, what do we have? We have this anonymization affected everyone simultaneously. So we don't have a control group. We don't have a set of lenders that continue to observe race post-anonymization. Now, you might come back and say, you know what happened is that the lenders previously were lending more to Chinese, now they're only lending to Chinese as much as they were lending to minorities, okay? So it's not that minorities got better off, it's only that Chinese got worse off, okay? So that would be another alternative interpretation of the paper. Now what we do here is we basically split the sample into biased lenders versus unbiased lenders. So what is the thought experiment here? The thought experiment here is that if you are an unbiased lender, which is basically a lender that doesn't discriminate, you're probably not using name to discriminate. So we think of these lenders as the control group, okay? And we compare whether the lending decisions of biased lenders differ from the lending decisions of unbiased lenders, okay? And we don't find any difference. So we interpret this as evidence suggesting that, you know, it's not that the overall credit supply went down, because lenders now, previously they used to observe race, now they don't observe race, and then they decided, you know what, it's not worth it, let's cut back on credit, okay? Right. In the last few minutes that I have, I want to talk about interpreting these results, okay? So, do you think that this particular paper, the evidence for existence of discrimination, we think it's rather strong, because again, we observe whatever these lenders observe, we control for it, so we think that this is evidence of discrimination. Now, which theory of discrimination, you might ask, is the best explanation for these results? Now, this is, for those of you who have been following this literature, this is basically still continuing literature. I don't think that there is a conclusive answer about whether discrimination is taste-based or it is a statistical. Okay? So this is still a very much ongoing literature, and we still don't have perfect methods to disentangle between a statistical versus taste-based. Now, this has, recently there is a paper that says that you could have, if the beliefs are biased, you could have inaccurate statistical discrimination, and then if you have inaccurate statistical discrimination, the predictions are going to be very close to taste-based discrimination. Okay? So differentiating between these is going to be challenging. And then for those of you who don't know, taste-based discrimination is basically, you know, I don't get utility from lending to certain applicants, that is taste-based. A statistical is basically saying, look, race is an information about the quality of the applicant. It is important to differentiate between these two because the policy implications are going to be different, okay? All right. We do some heterogeneity, and I think that is what we can do, and I'm going to show you a few other things that we do. The first heterogeneity that we do is basically a heterogeneity by income. You observe that racial disparities do not vary by income much. We think of this as evidence that probably it is not accurate statistical discrimination. Because if it was accurate statistical discrimination, you would expect that for high-income people, they would use racial disparities is going to be less. Okay? All right, we do the same thing for income to debt, and we do two other tests to basically think about beliefs, and then our finding is that the beliefs are inaccurate. Okay, this is the slide before the conclusion. Let me talk about this slide, and then I will conclude. Okay, so this is, okay, I want to apologize for you not being able to see this, but basically the out of sample area under the curve of predicting race is very high. What does that mean? Other application characteristics have a lot of power when it comes to predicting race. Okay? Now, this is by algorithm. Okay, so this doesn't mean that lenders can do this. Okay, this means algorithms, and this is basically a data package that you can, every one of us can use. You can basically highly predict race out of sample. Okay, now I think this is important because this fintech literature, there are a few papers that suggest that if you use algorithmic decision making, we can overcome racial biases. Now this is true, but if race is highly predictable, and if you don't discipline the algorithm could actually pick up this race, and racial disparities could persist. So this is, in some sense, this is an indication that, you know, this might, what we do in this paper or what we find in this paper might be an alternative way of reducing disparities without relying on algorithms, which potentially the algorithms can triangulate race very accurately. Okay? Right. Let me conclude. Okay, so does anonymizing loan applications help minorities and reduce racial disparities? The finding of the paper is yes. And we think that, I think to me the interesting part is that high-income minorities benefit more, and that suggests increased lender reliance on objective credit risk measures such as income. Okay. Thank you.
Thanks. So thanks so much for the organizers for inviting me to present this really interesting paper. Okay, so the motivation for this paper I don't think is particularly controversial in this audience. Access to credit has first order importance for economic outcomes. But the question is this access to credit fair? Do different groups such as races, genders, or cultures have unequal access to credit? And is this due to statistical discrimination, which, as Poorya said, lenders are rational, but race or gender may provide some information about the creditworthiness of the borrower that they can use in their credit allocation decisions? Or alternatively, is this unequal credit due to taste-based discrimination, where lenders specifically derive utility from lending or not lending to specific groups? And if access to credit is unequal, what can we do about it? And I think this paper kind of addresses both of these questions. And the short answer is that anonymizing credit applications can reduce inequities in access to credit across race. That's the punchline of the paper. And I think these are important and very cleanly identified results with direct policy implications. My comments are going to focus on three things. So I think one is beefing up a bit the institutional details. Second, I have a couple minor quibbles with the empirics. And then third, some thoughts about interpretation. Okay, so just as a recap of the setting here, I'm not going to go through all the details, but this is the consumer loan market in Singapore. These are loans that are short-term and unsecured. And what's, I think, very important, these aren't, we shouldn't think of these as like relationship loans. These are kind of mechanical lending decisions where the lenders don't know so much about these specific borrowers. And why is that important? And Poorya, I think, mentioned this. I would say, from an outsider perspective, an issue with this literature is what people will do is say, okay, let's take a bunch of variables that we think relate to lending outcomes, regress a lending outcome on those variables, and we see that gender or race or something lights up, and so we think there's discrimination here. Well, the problem is, in many contexts, we don't actually observe everything that the lender sees. The lender may have a relationship, the lender may have some soft information, and that can be correlated with race, gender, culture, etc. That's not a problem in this paper. What's cool about this paper is that Poorya and his co-author had the exact same information that the lenders have. So unobserved, by definition, at least I think, unobservables cannot be driving the results. They have the econometrician's information set is exactly the same as the lenders. And I'm going to come back to this point later. So what do they do? At the end of September 2021, the platform removed applicants' names from the application, while the authors get to still see the names, and what they do is compare outcomes before and after this anonymization period. Okay, that's kind of the setup. What I want to understand a bit more is more of the details of the institutional setting to then kind of understand how we can apply this to different situations and understand a bit more about what is the mechanism leading to this differential effects prior to anonymization. So first, this was kind of a minor part of the presentation, but I want to know, like, these borrowers, after they get an offer, they go in and meet the lender in person, and then in some instances, these offers can get reneged. So I want to understand, like, how easy is it for the lender to renege? Is it just a paperwork thing, or can they see them and say, okay, never mind, I don't want to lend to them anymore? I think this can also help us understand a bit more of the lender's incentives to distinguish what type of discrimination could be going on here. And then second, a bit more details about what exactly is observable to lenders. Can they see how many other applications the borrower made? how many offers they're getting? Can they see if they already met someone in person or were previously rejected? All that could be very relevant information in terms of how the offers that each of these lenders make individually in case of adverse selection issues and things like that. And this comment, I think, ties in a bit with the previous two. What exactly are the incentives of these lenders? How are they thinking about deciding to reject someone? Now, I was a bit surprised that a large portion of these applicants don't get an offer. Only 44% do. And so I'm curious, like, why don't prices just adjust based on borrower characteristics? Granted, I'm sure there's some kind of moral hazard problems and adverse selection that may be leading to that, but I think understanding more what the lender's actual incentives are can help us think more about the extent to which they're discriminating and why they might be doing that. And then finally, I don't know anything about race relations in Singapore, so I think delving a bit more into that to think about external validity, where we can apply this or not, can we apply this in the US, that could be helpful in the paper. Okay, minor quibbles on empirics. So the main specification the authors are doing is this kind of diff and diff estimation with time fixed effects, lender fixed effects, some time varying controls, minority times a pre-dummy plus minority times post-dummy. I don't think this is controlling for the overall effect of minority. I was surprised that it wasn't just kind of a standard time series diff and diff where you control for minority on its own and then also have an additional interaction term with minority times post. I could be missing something here. And I think this issue kind of arises later when the authors analyze loan performance because it's not clear how just being a minority on their own is affecting this loan performance. That's kind of a minor quibble. A second quibble is with kind of these parallel trends assumptions. So it wasn't completely clear to me exactly what T0, date 0 was in this setting because I think they say that this is the month of anonymization, but that's occurring at the very end of September. So I'm not sure if the entire month is treated as the period of anonymization. My suggestion is to set date 0 as the last in the pre-period prior to anonymization as September 1st through September 28th, and then T+1 can be the period after this anonymization took place, and then see how the outcomes evolve afterwards. And then also I think there could be some discussion of why we might see minorities seem more likely to be getting funding 3 months after anonymization. And I think that could tie into my kind of next comment that I'm going to give. So, okay, interpretation. So after this anonymization period, there's still actually a large gap in interest rates across minorities and the majority ethnic Chinese. What this suggests is that a large component of this gap has to be due to other observable characteristics. These lenders, they can't see race. So if we observe some difference in interest rates before and after across minorities and non-minorities, there must be some type of non-linear relationship between these characteristics that this linear model maybe is not picking up. And perhaps the lenders are indirectly discriminating through some characteristics of the borrowers, but in principle, this unobserved component, this name of the borrower, the lenders can't see that. That shouldn't be predicting a difference between a difference in interest rates if you're controlling properly for all the observables or using the correct model. So I would think about using some type of nonlinear method to kind of get this closer to 0, if that makes sense. And then I think, relatedly, I think this makes it a bit hard to interpret the heterogeneity and the results in the paper, because in essence, if you're not predicting interest rates properly with observables, then it's hard to understand why they would be varying across minorities with different levels of income, et cetera, when the relationship between interest rates and income may be highly nonlinear. And then second comment, and I think this is, you did give some caveats regarding this, distinguishing between taste-based discrimination and statistical discrimination, we kind of have to understand whether minorities and Chinese have different levels of risk. One indication that minorities may be more risky is the fact that we still see a large gap in these interest rates after anonymization. And I think these tests on performance don't say too much because there's just not a lot of power. Now, if there's a way to get from those lenders some kind of ex-ante measure of the riskiness, of the probability of default or loss given default, I'm guessing that's not the case. That might give you more power in the test because default is just such a noisy measure of performance or risk, of borrower risk. But I think without getting, I think there needs to be more on this kind of channel. Maybe it has to be through more data to be able to distinguish between these channels of the taste base versus statistical discrimination. You really have to know, are there differences in risk across these minorities versus majority groups? I guess, yeah, that's decent timing. Okay, so just to conclude, I think the punchline of this paper I think is very simple and intuitive, and that is that anonymization improves lending outcomes for racial minorities. And I think this is a super clean setting to analyze the effects of this type of policy. My suggestions are beefing up the institutional background so we can try to understand where we can apply this, the external validity of these results, and then also to interpret them in a better way. I would standardize the empirics a bit more, then also work on this interpretation, maybe try to do some type of nonlinear method to close that gap in the interest rates across the different names of the applicants. And then finally, I think the paper, I think you should sell a lot harder this idea that you have the exact same information as the lenders, because I think that's resolving a huge identification issue in the literature and can really distinguish the paper from other papers in the literature. But I really enjoyed the paper, and good luck with it, and happy to discuss more any of these comments in more detail. I also left some other random comments while reading later in the slides, so that's all I have.
Thank you for the great discussion. Okay, so I don't know what to do because I think I cannot get through all the comments. I'm going to spend a few minutes answering some of the comments, and then I will take questions from the audience. Okay. Okay. I can do this. Okay. Yeah, okay, so basically I think lenders can renege on these offers. These are initial, in principle offers, so I don't think that they're legally obliged to follow up on this, but they can come up, some of them they say, so you have reasons for rejection, they say insufficient documentation. Now, insufficient documentation could be something subjective, could be something objective, yeah, hard to say. What is observable to lenders? So the answer to all of these questions is basically no. So basically they only see the application, they decide to whether give an offer or not, and then that's it. How do they reject someone? Okay, so why do, I don't know exactly how they reject someone. It's basically, actually one thing that I know is if you run prediction models on whether someone is going to get a loan offer or not, you can actually highly predict them. So basically, my answer to that is they basically look at application characteristics and make these decisions. Why don't prices adjust? There is a legal limit in Singapore on the interest rate. So it is at 48%. And if you look at one of the appendices in the table, you see that there is a huge bunching in 48%, because this is the legal limit, okay? More background on race relations in Singapore. It's basically, it's a racially harmonious, you can think of it as a racially harmonious society. The Singapore government actively intervenes in the housing market and other markets to make sure that different races coexist peacefully together. And actually, there are a few papers published in RFS, JFE, and Review of Economic Studies exactly talking about this, okay? Okay, so the reason that we didn't do this is that we wanted to show in the same regression that there exist racial disparities pre and racial disparities post disappear. So that's the reason that we set up the regression like this. But we could do this, or we could, so the beta 1, the beta 2 that you're interested in, is basically the difference between beta 2 and beta 1. We took it out of the paper, we just write it in the paper, but it's basically equivalent. Okay, so this one, so we might not be very clear in the, when we are explaining, but basically we are taking September 28th to October 28th as our free. Part of the reason that we decided to do this is that if you do 0, if you make minus 1 equal to 0, then you will observe increased lending to minorities, and it would become a very confusing figure. So that's the reason that we decided to put it post, but it's true, you know, we can change this, okay? Yeah, I agree. I mean, I agree that part of it could be model specification. I just don't know. We did try a few different models. It looks like this doesn't change the main result, but I don't know what is the better way of, you know, addressing this model specification. Okay, let me take some some questions from the audience, and then we can talk. I'm happy to talk about the discussion. Yes.
So actually, if you go back to the specification that was suggested with the interaction, one thing I was wondering, so in the pre-period, the best predictive model of, let's say, someone's default probability is going to include the x's and then minority. Exposed, you don't have minority, so my optimal predictive model is going to have different coefficients on the x's.
Fantastic question. So actually, this is something that some people take issue with, but we have time-varying coefficients and controls exactly because of this concept. But some people don't like it, but yes, we do that, yes.
Okay.
Fantastic, yes.
I'm also wondering about the same, the empirical model. So you say when you subtract B2 from B1, that's more about giving the coefficient of what the discussant was saying, but that kind of also changes the standard errors, not necessarily just the coefficient. So the statistical significance may not remain.
Okay, so the first, I mean, we have done this. It's the test that is like 16 or whatever. It's like so crazy that whatever you do, it doesn't matter. We have 300,000 observations. For that particular one, I don't think that it matters. We did formal statistical test. And you know, honestly, I'm using this data package. Maybe you tell me that this data package is wrong. Happy to use a different one. But you know, the TS stats are so large that I don't think that this particular one is going to make a huge difference. You asked a question about lender experience. Well, the answer is we basically got lender data. Basically, we have lender experience, we have interacted with lender experience, and it doesn't matter. Now, it could be because our measure of lender experience is poor, but we have tried to get a measure of lender experience. We can talk about more about how we got this, but yeah, it doesn't matter. It doesn't dawn on whether you discriminate more or less pre and post.
Any more questions?
All right, fantastic. Thank you.